Good morning, everybody. Mike Vacchi, PrincetonTrader.com, here for NTMarkets.com with your Monday morning pre-market webcast. Okay, S&P 500 futures, daily chart, and Friday after the jobs report, we printed as high as 2103.5. We stalled there. We broke through the middle band in the 93-94 area. We then broke below the 80 to 83 floor that we had established back in mid-February. We traded as low as 65.5, and we're now down testing the area of the red line there, which is the 50-day exponential moving average. So we have sealed the middle band as resistance. It is not tested resistance, though. I will stress that. So the chances of a move up to test middle band resistance are pretty decent. We are below the middle band. We are now in sell rallies mode, and the initial target on any move this week has to be the lower band down at 20.55.5, or wherever the lower band happens to be when we get there. So we should trade down to lower band. But when it comes to the bears, there's always a but. But the dip buyers have been very successful coming in and buying first day breaks of the middle band. They've done it for a long time. If they're able to hold the 50-day exponential moving average, we may get a decent bounce up here into the area of the former floor, which was 80 to 83. The weekly pivot this week comes in at 2084. So I'm not ruling out a bounce up into the 80 to 84 area with a secondary target potentially all the way back up to middle band. All of that can happen. All of that is very normal testing of former support areas. If the bears can hold on, if they can establish one of those areas as tested resistance, then the second part is the hard part, the part they've never really been able to do too well. And then make a lower low versus 65.5, then the bears can do a lot better than lower band. They can start to extend down into the area of the 100-day exponential moving average and potentially down to test the February lows down in the 1980 area. If the bears do what they've done so many times, then what you will see is you will see a pop here. You will see resistance come in. You will see that potential lower high, but then what will happen is the bears will create a higher low versus the lows of today and Friday, and that will propel the bulls back over the middle band, and then we're back to that uptrend business as usual. So this should be a very interesting week to say the least. So let's see what the reaction is to the first pop. Rallies should be sold. I am currently, I have some longer term shorts that I was taking profits on. I still have some. I'd like to add to those if the bears can demonstrate that one of these areas is resistance. At the same time, I am long from the close on Friday. I'm long 2068. I just took a third of that trade off at 2072 for four handles. I have, I'll probably just go ahead and do a 68 stop on the rest, so my risk is out. And that way, if we do a morning pop this morning, I can take advantage of that. So that's what I'm doing here. So watch some of these areas. The bears can trade down to lower levels. They just have to want it, and most of all, they have to execute. All right, everybody have a fantastic day. Follow us on Twitter at Princeton Trader. Check out the website, PrincetonTrader.com. Come check out the chat room. Check out the live chart with the scroll. Come trade this stuff with us. If you trade this stuff every day, I would encourage you to come on in. You know, the area that the room was looking at before the jobs report as a potential exhaustion area was 03.5. It really doesn't get much better than that. And then we hung around the middle band for an hour before we dropped. Anybody that wanted in had plenty of time to get in, and then we went ahead and we did 30 handles down. So come check us out. We would love to meet you. I'll be back tomorrow morning with another webcast. Trade 'em well, everybody.